Hello, and welcome to the latest installment of Legal Bites, the official podcast of Cummings and Cummings Law, where we focus on helping businesses and their owners re-domesticate out of volatile legal and tax environments like Minnesota to more predictable pro-entrepreneurship, pro-growth jurisdictions. Today, I am exploring the top 5 reasons why small and medium sized business owners are evacuating Minnesota en masse. And no, that is not hyperbole. I will then conclude by explaining how small and medium sized business owners can use the same laws to their advantage to relocate out of Minnesota or out of another jurisdiction to a new state while keeping their existing federal employer identification number, contracts, bank accounts, and other obligations intact, while freeing themselves of the burden of Minnesota tax nexus and legal jurisdiction. But first, a brief introduction. My name is Chad Daniel Cummings, and I am an attorney and certified public accountant serving clients in matters of business, tax, and commercial law. I am Chief Executive Officer of the multi-state, multi-attorney law firm Cummings and Cummings Law. And in addition to my day job, I also teach business and tax law at the university level. I hold 4 degrees, including 2 law degrees, as well as a bachelor's degree in accounting and a master's degree in taxation, in addition to 12 professional licenses and certifications covering accounting, tax, audit, financial planning, and of course, the law. My firm website is www.cummings.law. Now, I will not bury the lead. If you are a business owner, Minnesota hates you and is doing everything in its power to bleed you dry. If you do not believe me, you have not been keeping up with the changes, actual and proposed, to Minnesota's tax code. Here are the top 5 reasons why it makes no sense whatsoever to continue operating in Minnesota if you are a small or medium-sized business owner and if you have a choice in the matter. Number 1, Minnesota taxes capital gains at a rate higher than ordinary income. That is backwards of the federal tax regime. This is the single most destructive provision in Minnesota's tax code, and most business owners do not know it exists until the year they sell, usually because of inadequate or incomplete tax planning and advice. Minnesota recently imposed a surtax on long-term capital gains that brings the top marginal rate on investment gains above the top rate on wages and salary. Every other state in the union and the Federal Internal Revenue Service have set capital gains rates at or below ordinary income rates to incentivize investment, entrepreneurship, and risk-taking. Minnesota inverted that relationship. If you build a company in Minnesota, grow it for 20 years, and sell it, the state taxes the gain from that sale at a rate higher than it taxes the paycheck of the person who bought it. That is a serious form of punishment if you are a business owner, and one that should not be underestimated, because sooner or later, whether or not you like it, you will eventually exit your business. And the question is, how much will you take away from the table? The tax code, as I said, punishes the exit more than it punishes the labor. For a business owner planning a future sale, merger, or any liquidity event for that matter, the capital gains surtax converts Minnesota from an expensive state into an openly hostile state. Remember, some states like Florida and Texas impose no capital gains tax at the state level. Reason number 2, the top marginal individual income tax rate is almost 10%. That is eye-wateringly high and is the 5th highest in the United States. For business owners operating pass-through entities, every dollar of business income above the top bracket threshold is taxed at 9.85% at the state level before we even start talking about federal taxes. On $1 million of pass-through income, Minnesota's state income tax bill is almost $100,000. If you were in Florida or Texas, that would be an additional $100,000 in your pocket. Over 10 years, the difference is nearly $1 million before we account for the time value of money. That is not a rounding error. That could be, frankly, a really nice car. I would say a house, but I don't think $100,000 is going to buy you a house anywhere. If you know of a place, it's probably not a place you would want to be anyway. Now, contrast all of that with Indiana at 3%, Iowa at 3.8%, Wisconsin at 7.65%. And by the way, South Dakota, only one state to the west, imposes no state level income tax at all. Minnesota is the most expensive state in the Midwest for personal income, and it is not even a close call. Reason number three, the corporate income tax rate is also extremely high at almost 10%, 9.8% to be exact. That is the second highest in the country, behind only New Jersey. Minnesota imposes an alternative minimum tax on corporations in addition to and not in place of the regular corporate income tax. The state includes net CFC tested income in its corporate tax base, taxing international income earned by foreign subsidiaries of companies domiciled in Minnesota, regardless of whether the economic activity occurred in the state or even in the United States. That is extremely unfavorable for business owners. A Minnesota corporation with a subsidiary operating in, for example, Germany, get this, pays Minnesota income tax on that subsidiary's earnings. The tax foundation describes this treatment as having nothing to do with a company's activities in the state. The corporate rate, combined with the GILTI inclusion and the alternative minimum tax provisions, makes Minnesota one of the least competitive and least desirable states in the country in which to operate a subchapter C corporation. Reason number four, Minnesota imposes an alternative minimum tax on individuals. This is in addition to and not in place of the alternative minimum tax on corporations or the federal alternative, there we go, minimum tax regime. Minnesota is one of a small number of states that maintains an AMT on individuals, requiring some taxpayers to calculate their liability twice, once under the regular income tax provisions and once under the AMT provisions, and pay whichever is higher. The AMT adds significant compliance costs, planning difficulty, and effective rate increases that do not appear in the headline rate of 9.85%. A business owner who claimed legitimate deductions under the regular tax may find those deductions disallowed and unclaimable under the AMT, producing a higher tax bill than the graduated rate schedule would suggest. That is to say, things are even worse than they might seem. And finally, reason number five. Yes, it gets worse. The legislature is openly considering a wealth tax following California. A bill introduced in the Minnesota House would impose a 1% annual, so this is a recurring tax, an annual tax on non-real assets exceeding $10 million for individuals and trusts. This is not a billionaire's tax. This is a tax that affects business owners. That is a tax on what you own, not what you earn. Remember, you've already been taxed on what you've earned. Now you're being taxed again. It would be assessed every year on the value of financial assets, business interests, and other non-real property. If enacted, Minnesota would join the list of jurisdictions attempting to tax accumulated wealth in addition to income, which raises some serious constitutional questions. The threshold is $10 million today. The California wealth tax started at $1 billion, and according to California Congressman Ro Khanna, should drop to $50 million when he made that statement publicly. The pattern is the same in every jurisdiction, and we've done several episodes on wealth taxes in earlier episodes, earlier installments of Legal Bites. The threshold always starts high to make the tax politically palatable, and then it drops. Minnesota also imposes a state-level estate tax in addition to the federal estate tax regime, with a top rate of a whopping 16% and a split roll property tax that punishes business owners by assessing commercial property at higher ratios than residential property, thereby shifting a disproportionate share of the property tax burden onto businesses. Every one of Minnesota's 5 neighbors offers a better tax environment. Most notably, South Dakota, which imposes no income tax of any kind and ranks second in the country according to the Tax Foundation's most recent state tax competitiveness index. North Dakota's top rate is 2.5%. Iowa's flat rate is 3.8%. Even Wisconsin is better with a top rate of 7.65%. The most expensive states in the region, the most expensive state in the region, which is Minnesota, is surrounded by states that are competing for residents and businesses by cutting rates and simplifying their codes. Minnesota is doing the opposite. With this context in mind, redomestication is the lesser known legal process of transferring a company's state of domicile to a new state without dissolving it, without creating a new entity, and without triggering federal income tax repercussions, but only when performed with the strict formalities required by the Federal Internal Revenue Code, applicable Treasury regulations, and the statutory frameworks of both the destination and departing states. When performed by a competent professional, the company retains its existing federal employer identification number, contracts, credit history, and bank accounts. That is to say, there is zero operational or financial disruption whatsoever, but only if you know what you are doing. That is why it is so important to work with a credentialed professional and save the DIY for home improvement. I have successfully completed redomestications from all 50 states, and that includes Minnesota, and for limited liability companies, partnerships, subchapter S corporations, and subchapter C corporations. So if someone is telling you it cannot be done, what they are really telling you is they don't know how to do it. Now, foreign entity registration is not the same thing as redomestication, because foreign entity registration, also referred to as foreign qualification, does not change the company's domicile. In fact, it does the opposite by keeping the company in the former state indefinitely and merely adding another layer of compliance and tax obligations in the destination state, leaving you anchored to the state you thought you were leaving. Meanwhile, a traditional merger, which is still not the same thing as redomestication, creates a new distinct entity in the destination state, may and often does require the issuance of a new federal employer identification number, and can trigger serious tax consequences. Finally, dissolution should not enter the conversation at all, because dissolution terminates the company. Dissolution is a going out of business maneuver, not a relocation mechanism. Dissolution is often a taxable event, and to make matters worse, when performed incorrectly, can expose the owners of the company to unlimited personal, yes, you heard me right, personal, joint and several liability for the company's liabilities, known and unknown. That is because the so-called veil of protection no longer exists because the company no longer exists. If you think dissolution is a savvy cost-saving mechanism, you do not understand the law. And if you have a so-called professional suggesting dissolution as a relocation mechanism, you need to seek better advice. Redomestication, when paired with the change of personal residency and that is an important and, a reduction or outright cessation of business operations in the former state, Minnesota in our example, can reduce or even eliminate state tax exposure there for the entity and its owners. Don't take my word for it. Ask your CPA. Now is the time to consider acting before the Minnesota State House considers changes to Minnesota law to hinder or even eliminate the option of redomestication. If you have questions regarding potentially redomesticating your existing limited liability company or corporation out of Minnesota or out of another jurisdiction, please use the link in the description for more information on this process and to schedule time for you and I to speak one-on-one about your specific scenario. Again, my name is Chad Daniel Cummings of the firm Cummings & Cummings Law, and I hope that you found this information interesting. As always, the information in this presentation is necessarily general in nature and is not legal or tax advice, nor should it be construed as such, because that advice definitionally must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my earlier presentations on these topics, of which there are quite a few, please visit my firm website at www.cummings.law, not .com, but .law to schedule time for a consultation. I look forward to that opportunity to speak and perhaps even work with you very soon.